everybody. With fluctuating company fortunes and market trends, it's extremely essential to analyze the creditworthiness of companies that you're in business with. Without a robust system which can assess creditworthiness, any business extending improper credit limits to its customer can cause a lot of issues in mitigating credit risk for the customers across their life cycle. Today, we have with us Gurpreet Singh Kharbanda, who will help us understand the significance of digitizing credit risk management and how the credit risk solutions at HighRadius benefits the B2B companies by providing them a strong credit scoring policy which helps to reduce risk and drive revenue. Hey Gurpreet, would you like to please go ahead and introduce yourself to our listeners?
My name is Gurpreet. Been working with HighRadius for a little over 2.5 years now. I am currently looking after one of our fastest growing product portfolios, Credit Cloud. Prior to HighRadius, I was into business consulting for almost 7.5 years, which I got into right after my MBA at Great Lakes, Chennai.
Based on the customer calls that we've analyzed, Gurpreet, we've seen that most companies largely rely on banks and other online credit tools like, Data Excel for credit risk scoring. Now, these traditional methods are manual and limiting and inaccurate. So can you explain us the shortcomings of relying on traditional methods for analyzing credit risk scores?
Number one, efficiency, right? So if you think about any credit management SaaS platform like Credit Risk App, one of the most important things that we do is data aggregation. When you're trying to onboard customers, review existing customers, think all possible external sources. You've got credit agencies, insurance agencies, bank and trade partners, right? In the absence of this automation of aggregating data from multiple sources, your credit teams will end up spending a lot of time gathering the data in the first place. The second efficiency variable there being, which is a rules engine. So think about all the work distribution, for example, assigning ownership, scoring strategies, pulling these reports, coming up with calculated credit limits and whatnot. All of this also becomes very manual and cumbersome. Third main element being approval workflows, right? So think about, depending upon the limit that you want to extend to a prospect, it might need to go through multiple levels of approvals, right? Again, in the absence of automation, all three of these, data aggregation, rules engine, approval workflows, absence of these will have a drag on the efficiency of the credit teams in general, right? That's one of the main problems. Second being compliance, right? Now, manual means subjective, right? So if you've got a team of 5 credit analysts, 10 credit analysts, right? Driving your credit policy in a uniform manner is not really possible. There is bound to be some amount of subjectivity in the credit related decision making, which is not very healthy for any business. Now, we've seen in many geographies, it is in fact a legal bindation for the businesses to ensure reevaluation on certain intervals. Again, keeping a track of all of this manually becomes very difficult for credit team. Third and oftentimes overlooked aspect of having a proper platform for credit management is auditing. Now, credit decisions are very sensitive and they have a big impact on the business's health. Now, any decision that is made, it needs to have the right justification and needs to have an audit trail, right? If at any point in time you need to go back and revisit as to why a certain decision was taken, you should be able to get those data points really. Again, one of those things that in the absence of having a proper tool to help you with, something that can't be done very efficiently.
So if I ask you from the perspective of a CFO, how does our product enhance a team's productivity and helps to manage credit risk better compared to these traditional methods?
I've got 3 words for you, right? Portfolio risk management, right? Now, credit is traditionally a centralized function and it has small teams that manage a disproportionately large number of customers, right? Now, it is humanly impossible to ensure high coverage for a 5-member credit team to be looking after, let's say, 50,000 or 10,000 odd customers. We've seen as low as 20% existing customer reviews. And this was all pre-COVID when things were much more predictable. Now, the health of businesses these days is much more volatile, right? And we've seen an increased appetite for leading indicators, real-time monitoring, integration with multiple sources for redundancy, just to have that confidence in your credit decisions. Smaller customers are equally important these days. And we've seen that mindset shift in most of our clients. And if you want to do again all of this, so this is again on the risk mitigation standpoint. Technology also comes to your rescue if you talk about all the productivity of the analyst, essentially. So features like alerts and notifications in the events of bankruptcy, judgment, anything essentially that can have an impact on your customer's ability to pay you back, you need to know about. And that gives you a lot of peace of mind. All of this automation that we spoke about with regards to data aggregations, rules management, approvals, it frees up the analyst bandwidth from the mundane tasks and can actually be invested in doing something that is core to these teams, which is keeping a tab on the risk while also ensuring how do we maximize the revenue potential for your business.
If we deep dive into what the mid-market CFOs want from a credit risk software, what would you say are their top, let's say, 3 requirements?
So faster rollouts is one of the things that we've seen as one of the most important tasks from our mid-market clients. So out of the box setup for credit applications, scoring models, workflows, you want to be up and running in virtually no time possible, right? So you don't want to spend months and months into design and then all of these requirements being configured or developed for you, right? So, and I think we've cracked that equation through our extensive research. We now know exactly what is needed for small and medium level enterprises, be it in terms of having out of the box plugins for the most common ERPs like Sage, NetSuite, Microsoft Dynamics, or set of capabilities that we know for a fact are going to be of use and can be it can accelerate your digitalization needs, right? So that's one. Number 2, again, in terms of expense to credit management, right? Historically, there has been 2 major elements to it. One is you getting your hands on the right data. So think DNB, Experian, Equifax, anyone, right? The other is a software provider like HighRadius or anyone. With credit risk cap, that's the other thing which is unique. We cut down on the expenses because HighRadius is both a data and a platform provider when it comes to credit risk cap. So you don't need to spend with 2 different providers. HighRadius alone can do the job of both an agency and provider for you. The third and important part, again, from a CFO standpoint in a smaller organization, is tracking the team's efficiency, right? So the amount of time that it is taking for you to onboard new customers, review existing customers, keeping a tab of your entire portfolio essentially is something that is of particular importance.
How is RadiusOne AR Suite's credit risk app packaged differently from the enterprise market first, the credit cloud?
See, now global enterprises have much more complex requirements, especially because more often than not, they've grown inorganically, mergers and acquisitions. Their IT landscape is much more heterogeneous, much more spread, right? So you're talking multiple ERPs, and there's a need to rationalize credit management across different countries. They can have opcos across the globe and such scenarios. Multilingual support, blocked order management is particularly important for them. You're actually talking support for much higher volumes of data and activity in case of larger enterprises, right? AI assistance, for example, becomes much more important for larger enterprises. They might even need things like credit insurance, depending upon which geography. So most of European enterprises we've seen rely a lot more on credit insurance as opposed to smaller customers or North American enterprises. We've also seen them go with multiple agency integrations. The other aspect that becomes particularly important for an enterprise level credit management is reporting needs for mid and senior level management. So a lot of what I spoke about in terms of portfolio risk management, understanding how you're exposed across different risk classes, who are your top customers that are amounting for the lion's share of your exposure and things like that.
The other question that I have is, Gurpreet, to what gravity do we use or leverage AI in our credit risk solution?
Right. So IR, like I said, so there's 3 major use cases for credit that we have at the moment. 2 of them focus on blocked order management. We do blocked order predictions for your entire customer base. We can predict for which of those customers there's a likelihood that you will get blocked orders in the next couple of days, right? And that is supposed to give you enough lead time for you to escalate your collections, reach out to the customer, make them pay, All in all, any blocked order is a disruption to your client's business and to your own business. Blocked order prediction in that sense helps avoid that disruption. The other is in terms of faster decision making for actual blocked orders. So the ones that have come through, we've got models that learn from your past decisions. So we feed them a lot of historical data in terms of blocked orders, AR data, past decisions that were taken, depending upon risk profile of the customer and the point in time attributes, like what was the limit at the time, what was the exposure, risk class, and so on. And once the model picks up on this, it can provide recommendations with a high degree of confidence, along with recommendations on if you should consider permanently increasing the limit on the customer. The third is around reading of financial statements automatically, right? So financials are really important when it comes to assessing the health of a business, really. And if you want to get these from the credit agencies, at times you end up paying a lot more. If you've got the customers who can furnish their own financials for you and you can trust them with that, you can just share a PDF of those financials, upload it in the product, or in fact get them submitted in your online credit applications, and we'll read through all of it, identify where those financials are, which periods, extract the data, make it available for you to just quickly review and submit.
So what, according to you, would be one feature that our customers would really be very happy to see in 2022?
One is around bad debt management. So both allocation of bad debt and approvals. There are multiple ways in which this can be sliced and diced for each of the clients, for each of the customers. At the end of the day, most of the businesses today end up setting some purse aside, right? So for some amount that you might not recover for them, right? And that's a big part of the financial planning for any year for most of our clients, right?
So Gurpreet, how much of an attention do you see a mid-market CFO paying to maintaining and managing creditworthiness of customers over years, right? So at point of customer onboarding.
One of the downsides and one of the prevalent practices pre-COVID, like I mentioned, was that while you did all your due diligence while onboarding customers, once they were onboarded, there was not a lot of attention given to them. So of four major use cases, right? Let's say customer onboarding, existing customer reviews, blocked order management, and alerts and notifications, right? Existing customer reviews used to get the lowest priority, right? And we've seen as just a fraction, like roughly 20% of the entire customer base being reviewed annually. While it is risky, most credit teams do not have enough manpower, which is essentially what makes it even more important for them to rely on such platforms that help automate most of the mundane tasks, improves the team efficiency, gives them all the actionable insights based on the data that can help them stay on top of the risk associated with their customer portfolio.
Thank you so much for your time today, Gurpreet. And for our listeners out there, stay tuned.